Hedge Fund Tips with Tom Hayes. This is for the week ending July 30th, 2020. We're recording a day early because I won't be able to record tomorrow night. So I'd like to kick it off with our first part, which is the media clips. On Monday, I was on Fox Business with Liz Claman for the Claman Countdown. Thanks to Liz and to Ellie Terrett for inviting me on. And during that segment, Liz asked me if there was anything I was concerned about in the markets. And the number one thing that came to mind, this was on Monday, was the extension of the enhanced unemployment benefits, which affects directly and indirectly some 30 million people, and whether they could get that passed by the end of the week or at latest early next week to keep those checks going to the people that have been most affected by the shutdown. That's number one. So it looks like there's a lot of back and forth this week. That may or may not happen. But I do think one thing is on the table that could be a game changer, and that is President Trump may have emergency authorities to keep those checks going without approval from Congress, in which case there would be no need to negotiate a fourth stimulus package. We've not even used put 50% of the amount that's already been allocated in the previous three packages to work. So there's a lot of runway, a lot of things that we can use if they are unable to get a stimulus package agreed to. But if they are, then you could not only get the enhanced unemployment, but you could also get the stimulus checks, which would be very positive for the economy and everyone wants for the lower income people that need it the most. And there are a number of things that are in the Republican package that Chair Powell referenced in the FOMC meeting on Wednesday, which is in particularly relevant to the banks. So it's called the Collins Amendment, which would relax capital requirements and give the Fed authority to adjust the Tier 1 leverage ratio for banks. It could be a temporary measure, which is what Chair Powell was talking about. Many other bank regulators have done that. And the basis here is that it would enable banks to increase their balance sheets, which would afford more lending, which would afford more profit making, which would be good for the recovery. So assuming they actually do push a bipartisan deal through, and this is part of it, this would be a huge catalyst for the banks. It would be a huge catalyst for the recovery with credit extension to Main Street. And so we'll keep an eye on that. If not, I don't think we fall off a cliff because I do think President Trump can keep those enhanced unemployment checks going. I don't think it'll be 100% of what it was, $600 a week, because anecdotally we're seeing that many people have been disincentivized to return to work because they're making more staying at home than they were in their jobs. But I do think it would be somewhere between what the Republicans are asking, which is $200 extra a week. The Democrats are asking $600 a week, probably somewhere in the middle, about $400 a week would do the job. And hopefully they could either come together on that or President Trump could get it done with an executive emergency order. So that's that. The other issue that I covered in the Fox Business interview was the idea of yield curve control, and Chair Powell alluded to more tools and more guidance moving forward. We'll cover some of that just now in the FOMC statement, but the yield curve control is very important because it targets the short end of the curve, unlike 1947, where they targeted the long end of the curve to hold rates down. Here they'd be pinning it down to the 5-year Treasury, which would dramatically steepen the yield curve and basically pour buckets of money into banks, which in turn will lend buckets of money to Main Street and to consumers and to small businesses. So it would be a good thing all around, and that's probably more of a conversation as we move towards September. So a couple major catalysts potentially for the banks coming down the pike. Thank you again to Ellie Terrett and Liz Claman for having me on. For those of you keeping score, this is the 41st Videocast and the 31st podcast. So we're humming right along here. It just time flies. Also on Monday night, I went on CGTN America with Mike Walter. Thanks for having me on. Also to AI Zing for inviting me on to Mike's show. And this was right after they put out the Republican HEALS Act, and I did a compare and contrast to the previous bill from the Democrats. And basically there were three core agreements. They agreed on doing another round of the stimulus checks at $1,200, $500 for dependents for lower income. They agreed on money for testing, $16 billion, the Republicans, the Democrats wanted more. And they agreed on extending the PPP program for small businesses. Where they disagree was the size of aids to states. They disagreed about liability protection for businesses and schools to open up for COVID liability, and they disagree on voter ID and mail-in voting. And I think this is ultimately the issue that destroys their chances of doing a deal. This is something that both parties feel very strongly about, and I think that's why we're more likely to see either a carve-out deal, which would handle the stimulus checks and the enhanced unemployment extension, or we'd see an executive order. But I don't think you're going to see agreement around liability protection and mail-in voting. So those are the key sticky points, and the drama will create some chop and volatility in the next 24 to 48 hours, probably by the time you're listening to this. So those were the core things that they agreed on and disagreed on. And, they go to recess on August 7th. So it's very low probability that they get a comprehensive deal agreed to, which would have been nice, particularly with regard to the Collins Amendment, which would help the banks lend more and juice the recovery for small businesses and consumers. But that doesn't appear to be in the cards. As Chair Powell said, plan for the worst and hope for the best. Maybe they get it done. Maybe they can meet in the middle on a bunch of these items and get it done. So that was the interview with Mike Walter. Thanks again. And then on Monday, I was in Reuters. Thanks to Devik Jain and Meta Singh for including me in their article. They basically wanted to know what was to focus on during the week, and I said that the market's looking at the stimulus bill as a nice bridge of $1 to $1.5 trillion to get us to the period where we either have a treatment or more likely a full vaccine toward the end of the year. So that's the idea of this. The bid on the Republicans is $1 trillion. The ask on the Democrats is $3.5 trillion. My guess is they could get something done at $1.5 trillion if they let go of liability protection and let go of mail-in voting. Whether they will or not before August 7th is unknown. But the key thing is to keep the money flowing, or at least a decent portion of it, to the 30 some odd million people directly and indirectly impacted by the shutdown. That's the bad news. The good news is a third of those people who have lost their jobs because of the shutdown have now regained them. The bad news is we got to cover the 2/3 of people until they can get back on their feet, and we get this completely under control. So moving on to the article of the week. This is one of my favorite songs, the Garth Brooks Friends in Low Places Stock Market and Sentiment Results. We've spent a ton of time in recent weeks on the Fed, on COVID data, on U.S.-China issues, and we could update you on all of that, but that's information that's readily available. So I'm going to stick to the concepts in this article because they are, in some sense, cyclically timeless, meaning we're at that range of window when we're going to start to see some of these things play out. And it's not, hour by hour importance. It's more week and month by month importance. And then obviously it plays out over years. So Garth Brooks has the legendary song, "I've Got Friends in Low Places." And I thought that was thematic because, the markets now, the S&P 500's had a 45% move off the lows. The Dow is about 41%, I believe, and the NASDAQ is about 54%. So huge move. Where do you find opportunity, remaining opportunity? Because, there's a tendency after huge moves like that to want to short it because it's recency bias, because you had such a crash in March. Everyone's looking for the next shoe to drop. Historically, that generally doesn't play out well. You will get consolidations, you will get the 5 and 10% pullbacks, but very, very low probability of getting, meaningful 20+% corrections after having a huge correction. So if you've already ridden a lot of the rally, or you haven't ridden the rally, where's the opportunity moving forward on a risk-reward basis? We saw tonight, obviously, Facebook, Amazon, Apple, and Alphabet blew it out of the park. They also rallied 20, 30 some odd percent into these prints. They're up big on the year. They'll probably run a little bit more, but they probably are going to take a breather in coming weeks. The buying is going to be exhausted in the short term, and then probably towards the fourth quarter again they'll resume their rallies. But they crushed it, and that's good for the economy. That's good for that sector, and it'll help the markets, which will help with consumer confidence. But what we want to look for is inefficiently priced pockets that are laggard, and that's why we talk about friends in low places, the ones that are left behind. We covered a couple weeks ago in our summary of the Bank of America Global Fund Manager Survey that tech was the most crowded trade according to the 200 survey respondents managing $500 billion of AUM. And we're going to walk you through 4 ratio charts that map the relationship of 4 unloved sectors relative to the most loved or most crowded sector, which is technology. And it appears after tonight it's going to get a little more crowded in coming days and maybe a few more weeks. But they have had a good run, and they are going to have to breathe at some point. We did see, obviously, in May when the coronavirus cases were coming down dramatically, that cyclicals just shot the lights out. That started again last week, and then it was delayed again this week with more flare-ups in new states. So, this is a constant push-pull. When cases go up and the recovery looks slow, we get a huge move into tech, yields come down, money has to pile in and pay up for what little growth there is, assuming that the slowdown, the reopening is going to be delayed. When it looks like there's a treatment or there's a vaccine or cases start rolling over, and we're seeing a little bit of that in the Sun Belt, but now we have these other regions we got to pay attention to, then it's back to tech because you got to pay up for the growth, yields are going to be down, etc. But look, the bottom line is, as this is happening on a day-to-day basis with the cases, thousands of scientists and doctors around the world are working day and night, and we continue on a daily, we're almost numb to it. Like, the data's coming out so good and so much faster than expected on these vaccines and even quite a few treatments that we're just numb to it. It's like, until they say, here's your vial, take your shot, your vaccine, or here's the pill that you take if you get a fever and it goes away. And there's been a lot of rumbling about different things that are working better or worse, etc. So one of these things, you don't want to bet against science, because one day you're going to wake up, there's going to be a solution, and then boom, cyclicals are going to just tear through the roof. So do you want to buy them when they're up, or do you want to buy them when they're down? That's a difference of philosophy. No one is better or worse. I tend to like to accumulate when things are down and then ride them up. Some people like to ride them when they've already moved up, buy them when they've already moved up 30 or 50% and they're making new highs. And that's just a different philosophy. That's more trading than investing. But we start with the quote from Warren Buffett: "I'd be a bum on the street with a tin cup if markets were always efficient." So what we're seeing in these 4 sectors that we're going to go through is inefficient pricing maybe not inefficient pricing relative to the Q2 2020 economy, but no question about it, inefficient pricing relative to the Q2 2021 or 2022 economy, which the market would start discounting, a year or more before. So, it's pricing a backward-looking scenario, and as we get closer to normalcy on the health side, it will start to price the forward-looking scenario. So, the first thing we laid out was, kind of a context. These are extreme divergences that embody the essence of the oracle's quote, the oracle meaning Warren Buffett. These aberrations will persist indefinitely. To believe that these aberrations are going to persist indefinitely, you're betting against population growth, you're betting against 85 million millennials moving aggressively into housing formation, accelerated by coronavirus. The trend started several quarters before coronavirus, but because the average age is 29, so that's the time that people do it. It's later than it used to be, but that's about par for the course now. You'd also be betting, when we talk about defense and aerospace, you'd be betting against any geopolitical tension, and I think that's a bad bet right now, and you don't have to watch TV too much to know why. And you'd also be betting against the yield curve steepening, which is already happening. So let's start with the yield curve. We updated this chart that we've put out a couple times in the last month or two, and it's basically the steepest it's been since 2009 and 2003. Financials had monster runs after the yield curve steepened this quickly. The other point that I made was that people are missing the forest for the trees, because while everyone's focused on record low rates, what they're missing is it's not the rates, it's the spread between the short end and the long end, which is now steeper than it was in 2009, which led to a multi-year multi-triple digit rally, and the same thing from 2003 to 2008. So you should definitely go look at the article on hedgefundtips.com, the Garth Brooks Friends in Low Places Stock Market and Sentiment Results. You can just use the search bar on the side, or go to most popular articles. It's already the top one of the week, and it was just put out this morning. Next, I then charted the XLF, which is the financials ETF, to behind the XLF to the XLK, so financials to tech. The last time financials had underperformed this much relative to tech, it happened only 2 times in the last 20 years. It happened in 2009, and you got a monster financial rally coming out of that. And it happened in 2000, and again, the same thing, a monster rally. So, and these are common themes that happen at the later stage of the cycle. Tech dramatically outperforms because people are paying up for the growth. Cyclicals outperform coming out of recessions. Tech outperforms, toward the end of cycles. So, and the reason for that is because people are paying up for the tiny pockets of growth. Where is that growth? Whereas once the recovery looks sustainable, the bar of growth is going to be so low that you get these high comps, high growth rates, and that's when cyclicals just roar on a relative basis to tech, because then you have lots of pockets of growth that you can bid for, and those few pockets that perform in slow economies are now competing for the investment dollar with a plethora of cyclicals, which are now growing at fast rates because it's the beginning of the new cycle. So wanted to emphasize that. Okay, so what we're talking about Buffett's quote about inefficiency, if he'd be a bum if the markets were always efficient. So what was inefficient about 2009 and 2000, where financials were trading so compressed relative to tech stocks? And what was inefficient was that everyone was looking at the recency bias, meaning that the credit risk, because you were in a recession, 2 quarters of negative GDP growth, which we just booked today. And everyone was backward looking, oh my gosh, all these people are losing their jobs. You're going to have credit defaults, credit risk. You're going to have defaults, et cetera, et cetera. But that's backward looking. And as we covered last week, the banks have already over-reserved for that due to the accounting change with CECL. They've taken 100% of the losses. And as those prove to be too upfront, as those prove to be too conservative, those reserves will be reversed, and that'll come back on as income and earnings for the banks. But anyone looking out 1 to 2 years would have acknowledged that while the banks were trading at a discount to book, and we still have several right now trading at a discount to book, which we've covered in recent weeks, it would revert back to normal over time. So that's the inefficiency. Right now, they're saying that they deserve to trade at a discount to book because the defaults are going to persist in perpetuity. And we know that that's not true. So in this cycle, banks are part of the solution, not part of the problem. They're under leveraged, not over leveraged. So the same will be true this time. And just to put it in context, Warren Buffett it reportedly bought over $5 billion of Berkshire stock, did buybacks within the company in the last few weeks, but he just bought $1.2 billion of Bank of America in the last 8 days, which is on top of it being, if not his top position, his top 1 or 2 position. I think it's his top position, and Wells Fargo is in his top 5, etc. So he's making a huge bet on the Main Street recovery, and he's back in the game. Now, what I loved about this article was that I dug up, there have been a number of articles in the last couple of few weeks and couple of months asking, has Warren Buffett lost his touch? So the Financial Times had an article, light on tech, heavy on banks. Has Warren Buffett lost his touch? Motley Fool, has Warren Buffett lost his Midas touch? So these all came out in recent weeks, and they looked, and when I was Googling, I found the exact same headlines from the year 2000, which is when tech was dramatically outperforming relative to cyclicals and value, because you were towards the end of the cycle where people had to pay up massively for growth, and cyclicals and banks started to perform while tech was starting to roll over. So while everyone was saying that Warren was washed up in 2000, what happened over the next 8 years is Berkshire stock returned 274% in the next 8 years following the last time they asked the question whether he'd lost his touch. And tech was down 53.6% over the same 8-year period for a relative outperformance by Buffett of 327%. Now, for the skeptical people listening to this, you could say, yeah, okay, but what if you're 5 years early? What if it's 1998? What if it's 1995 and tech is just going to keep pushing and pushing and pushing, and the value and cyclical stocks are just going to stay subdued? Well, the other thing that you find is even in this up cycle, as we had mini corrections in 2015, in 2011, and 2011 from the Euro crisis, 2015 and 16 from the China and oil crisis. The bank stocks in particular, they trade in a range from a discount to book when things look bleak to a multiple of book, 1 times book, 2 times book. We've even seen in euphoric cycles 3 times book. And right now, you've got stocks like Wells Fargo trading at 35 to 38% discount to book. Just a year and a half ago, it was trading at 1.75 times book. In 2009, when the last time they cut their dividend, it was trading at a discount to book. Within two some odd months after cutting the dividend, 85%. This time they cut 80%. it traded back up to book. Right now, book's around $40 a share, so that would be a huge move, towards the end of the year. Plus, if it follows that same analog. For that to happen, obviously, we need to get a grip. We need to wake up, and we need to have some breakthrough to contain the virus. And whether that is a vaccine or a treatment or just herd immunity. I think these masks are helpful, and obviously we've been wearing it. Everyone up here, we went to Block Island and Mystic, local trip last weekend, and everyone in public is wearing the masks up here. So I think that's helping. But I also think when you look at these different regions as it's migrating to different areas, these are not second waves, these are new waves for different areas. You're seeing basically this abrupt peak and then a fade. And I'm not sure it's because everyone just wakes up and starts wearing masks. I think it actually, as we've covered in recent weeks, it hits a critical mass of the population, of people that build antibodies, people that aren't tested, that don't even know that they had it. And you hit, it might be 20%, it might be 50% with antibody people, but some critical mass in the population where there are just really no material amount of hosts left, and the virus just slowly dies down, and then it compounds with people following the directives with the masks, and that helps it as well, and then it just kind of goes away, as we've seen in the epicenter, New York, New Jersey, Connecticut. So it could be any of those things, but that's what's going to be needed to catalyze this rotation moving forward. So the other thing that Buffett said is opportunities come infrequently. Okay, so you'd have to look hard. Maybe you'd find 3-4 times in the last 20 years where you could buy these high quality money center banks at a discount to book. Not all of them, but some of them. And when you did each time, you were handsomely rewarded over the next few years. So what Buffett is saying is when it rains gold, put out a bucket, not a thimble, and that's exactly what he's doing these days with his own with his own stock, which is a financial, with Berkshire stock, with doing a $10 billion natural gas asset deal for another cyclical sector, and then doing the $10 billion Oxy deal last year, which in the short term has been a disaster, and 3, 4, 5 years out, it's going to be a home run, probably multiplied times 5. When you look at the supply-demand imbalance, and everyone's going to say, yep, he's a genius. Right now they're saying, has he lost his magic touch? Then they're going to say the undisputed, heavyweight champion of the world 5 years from now when he's on top of the world again. So, there's an old adage in the business, by the way. The best time to buy a manager is a proven manager who's had a rough patch. Most people, when they buy mutual funds, they look at the last 3 years' performance and they buy someone after, right after they've had a 5-year run, and they're top ticking it. In the case of Buffett and what he's buying, right now he's a little bit out of favor, but that's when you buy the best of the best. It's just like you buy the top banks when they're trading at a discount to book in the middle of a recession, because as you come out, they're going to have the fastest growth in the early parts of the cycle. You also buy the best managers when they're underperforming in their strategy, because their strategy, provided they don't have style drift, comes right back and they just fly and outperform everyone. So that's just a little tip. But okay, so the next sector that we covered is defense stocks relative to tech stocks. And the last time we had a divergence where they've underperformed relative to tech, which is the most crowded. So defense, industrials, aerospace, early cycle outperformer because the growth bar is low. Tech, late cycle outperformer because the growth is scarce and people pay up for it. Last time we saw this was 2003. And basically, and also in 2012. What happened after that, the defense sector rallied 201% and then 346% after such an extreme like this. So, to bet against these opportunities, you really have to say that no one's ever going to fly again, or, no one's ever going to want to defend their countries. And, the big elephant in the room is the increased rhetoric with China. They're a little bit behind now on their phase one purchases. I think they'll probably pick up the pace. But, there are a number of points of rhetoric between the South China Sea, between what happened in Hong Kong, between now with Taiwan. That kind of rhetoric is going to continue to persist. Whether it leads to anything more is unknown. I'll usually take the under on that. But what it is going to do is draw attention to the need for defense strength. And it's also going to draw attention to the low valuations of the defense and aerospace sector. So that's another one that, I'm kind of pound the table, very interested in and adding on weakness. So the next area is energy to tech. We've covered this quite a bit. And the last times that you had that, the XLE, I did the XLE relative to tech. When it was trading at this big of an extreme, you have to go all the way, again, back to 2000. And the XLE had a 393% rally following that period of inefficiency. So, there's a lot of talk about electric cars. It's the future, but you also have a growing population. We're going to need all types of energy. We're going to need 100% of whatever we can produce in renewables and solar, 100% of what we can produce in carbon, because the population is going to continue to grow. And we're myopic in that we look at the developed world and the birth rate going down. But, when you look at the major growers in the emerging markets, in Africa, in India, those populations just continue to grow and are going to continue to just accelerate. So we're going to need all the energy we can get, renewables, energy, carbon, etc. And I did a 30-minute segment for CNBC in Indonesia. If you want to see about commodities, inflation, emerging markets, trends, demographics, it's very comprehensive and definitely worth a read if you want to get into greater detail. But if you want to just get the theme is we are at an inefficient period. These are priced for death. They're priced like whale oil. And I think that's a premature bet, the whale oil bet. I don't think we're close to that yet. That might be 30 years off. And the population would really have to stop growing for that to be a legitimate thesis. And that's not showing up in the data at present. So as I mentioned, Warren Buffett buys when other people are selling. He did a $20 billion of deals in the last basically 12 months in the energy sector. In the case of Dominion, it was natural gas transmission and storage assets. He also got a big piece of Cove Point, which is one of the LNG terminals where we're going to be exporting the Marcellus gas out to Europe, out to all different parts of the world. So that's a very valuable asset that he got. This chart we put out about a month ago. It relates to the OPEC cuts, which persist through April 2022, and it anticipated that the build from coronavirus would turn into a shortage starting in late June and July. That has come to bear. If you look at the numbers since then, we went from the build from coronavirus, and now we've just had the biggest crude draw this week since last year. And as you can see here, this market, you've got 5 years of underinvestment in major projects, and that's all going to come to a head in 2021. But in the meantime, you're seeing these draws that are going to persist with this the OPEC cuts and the supply-demand imbalance. So I think Buffett's really well positioned, and if you look at history, it paid materially to be a buyer at this level of extreme divergence. And inefficiency. And finally, which we pounded the table on at the crash in March and April, was home builders. They've already had a monster run, so they're at new highs, and that's been a monster trade. But that's going to persist. That's a secular trend. That's just doing the math of the demographics of the millennials, 85 million. The last time we had a housing boom like this was the boomers, which were only 80 million people. They're starting a little bit later, the millennials, but they're starting now. And So there will be more opportunities. Those are buys on weakness. Although there has been no weakness lately, and that's a great thing, because if you were listening with us through the crash, you took advantage of it. Next, I can't tell you, so I wrap this up. I can't tell you when the downpour of inefficiency, that's what we're dealing with these 4 sectors / subsectors, will stop, okay? But if you look at it as a downpouring of opportunity versus, oh, when is money going to rotate back into cyclicals? I hope it's not tomorrow. I'd like to buy more, more weakness. Today, there was big weakness in the banks today. That was a huge opportunity. So these are periods of opportunity. And rather than begging for an umbrella and say, when's it going to change? Look for the bucket. As Warren Buffett says, in those few instances in life, opportunities come in frequently. When it rains gold, put out the bucket, not the thimble. And that's what he's doing, to the tune of so far $21 billion in cyclical sectors in the last 12 months. And I think there's 26, because he did $5 billion of his own stock reportedly. So that's a lot of money. That's about 20. That's about 20% of his dry powder. Remember, he's got a reserve probably $50 to $70 billion for potential COVID liability. That is uncertain for him. So he's effectively put up, call it half of the cash that he'd be willing to put up. And he also likes to keep $20 billion of cash lying around for a rainy day on top of what he expects worst case insurance liability to be. So, he's basically all in on this stuff that no one wants. And these are the times when they write these articles. Has he lost his touch? Is he out of it? And the next 5 years, he just crushes it because it's the beginning of a new cycle. He's loaded up on cyclicals and value, and it's off to the races. And it'll be no different this time. It's just a question of when. So, maybe they get to put a few more articles out saying how wrong it is, and then, he'll have the last laugh. Onto the general view, shorter view. What was surprising this week is the AAII sentiment survey results for individual investors came in. Bullishness dropped to 20%. Now, historically, this is a buy point. This is where you buy when there's that much pessimism in the market. Bearishness jumped to 48. These are both buy indicators historically. Not 100% of the time, but probabilistically, you want to be a buyer, not a seller, which is kind of odd when we're knocking on, obviously we're just about positive on the S&P. We're, new highs on the NASDAQ. It's like, there's a little bit of euphoria in the NASDAQ, and people just don't buy it, which means it pushes higher with the wall of worry. That's also confirmed by the Fear and Greed Index. After a 45% rally, it's only at 65. Euphoria is between 80 to 100. Haven't got there yet, man. People are not buying in, and that's the wall of worry to climb. Who has bought in the last week is the active investment managers are now at 97%. That doesn't mean you automatically get a crash. It does mean we got to keep our eye on it right now. You got another move like that in 2018. You got to move to 100, and the market just kept rallying. So, none of these are hard and fast, black and white, but you use them as a mosaic to just give you an edge to keep a pulse on things. So that's just a yellow warning light to keep in the back of our mind that we didn't have last week. But then we got 2 green lights from the other 2 indicators. So again, that was a big divergence though. So we remain very constructive in the intermediate term. We use any weakness to over the summer and fall to add to cyclical, unfavored, laggard, quote, friends in low places. So, wouldn't be surprised to see a bit of volatility and chop related to the stimulus bill and earnings over the next few weeks, etc. And that just creates opportunity. So until next time, it's time to make some friends in low places. Okay, we went through most of the key things with China as they relate to defense stocks. The Fed stepped up in the FOMC statement this week and said that they will use a full range of tools to support the U.S. economy in this challenging time, thereby promoting maximum employment and price stability goals. Path of the economy will depend significantly on the course of the virus. I just spent 20 minutes on that. And the committee decided to maintain the target range. Okay, so no move in rates, we know that. And the other thing that they put in here, which is not a big change, committee will assess realized and expected economic conditions relative to its maximum employment objective. So in other words, they're not going to change anything. All they're going to do is continue asset purchases until they're at full employment, which, we're at whatever it is, 11%. They've got to get that down to mid to low single digits. And it's symmetric 2% inflation objective, which means they want to stay above 2% for some significant period of time. And if they're fully symmetric, they would stay to the exact amount of time that they were below 2%, they would stay above 2%. They won't do that, but that's what symmetric means. So in other words, they're saying we're going to let it run hot if we can actually get it hot. And okay, to support the flow of credit to households and businesses, Federal Reserve will increase its holdings of Treasury securities and agency residential and commercial mortgage-backed security at least at the current pace to sustain smooth market functioning, thereby fostering effective transmission of monetary policy to broader financial conditions. In addition, the open market desk will continue to offer large-scale overnight and term repurchase agreement operations. So that gives them more flexibility. They haven't done much repo of late because that kind of calmed itself, but they're basically saying if we want to inject money quickly, we have and will do so. We covered the Collins Amendment. That would be amazing if that got snuck into the package. If we get a package, if we don't, I think we'll get an executive order and all will be well. Economic data this week, obviously durable goods orders was fantastic. I covered that with Liz as well. That was in line with the economic surprise index, beating to the upside consistently. The crude draw was a monster draw. They were looking at a build of 350,000. They got a draw of 10 million barrels. Continuing claims was a little higher than we would have liked. And, we're seeing, look, you can't, we saw that there has to be an impact of that. We saw it in the Sun Belt in recent weeks that was reflected in continuing jobless claims as, restaurants reclosed, etc. The GDP came in better than expected. Hooray, throw a party, negative 32.9%. Okay, so it was expected to be negative 34. Originally, it was going to be negative 40, according to, I guess it was the IMF. And initial jobless claims beat, so that's good. Expected 1.45, 1.43 came in, and that's not bad considering the spike ups. That's a good thing. As those spikes come down, it's stubbornly appearing to roll over new cases. If that would persist, if we've hit that critical mass, that would be an amazing thing. Tomorrow we have consumer confidence. That'll be an important number, so keep an eye on that. Earnings have been better than expected. More than 3/4 have beat so far. We'll see what that number looks like tomorrow. FactSet will put out their new analysis, but I guess it'll be in line with what we've seen, if not better. You can just see this is a sea of green. All these regional banks are just crushing it. Cincinnati Financial. Let's just go through a number of names here. These are all small companies, so I don't want to spend a lot of time. Asset Manager beat. Bank of Hawaii beat. Pretty much all the small banks. NBTB, NWBI, HTLF, LKFN. Not only are they all beating, all the insider buying you're seeing hit the tape is all these small and regional banks, people buying up their own stock. And you're seeing a ton of energy and financials. Today there was just a monster amount of Citibank call options, long dated 2021, 2022, January, you can see. And deep in the money, Citibank, like bam, 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 huge buys, institutional buys. You're just seeing it all over while everyone's focused on, it's kind of like the illusionist, the magician has you look at one hand, look at this shiny object called Fang, and then in the other hand, he's scooping up all these discounted, inefficiently priced stocks when you have a 12 to 24 month outlook. First bank shares, I mean, they're all just crushing it, just small bank after small bank. Citizen Financial. I mean, it is just beat after beat. Bank 7, I've never even heard of it. MRBK, they're just all beating in like a horrible quarter. Pfizer beat on Tuesday. McDonald's missed a bit. That's understandable. Restaurant business. Amgen beat. Starbucks beat. Industrials, 3M missed, of course. Raytheon beat. Stock still traded weak. Again, that's a defense stock. I think there's going to be huge opportunity. If I read correctly, there were a ton of F-35s in the Republican stimulus package, so we'll see if that gets through. Sherwin-Williams. It's not just the Republicans. I'm sure there was some fluff in the $3.5 trillion deal as well on the heels. What do we have? Heels and hopes or something? Let's see. Heels and... I knew this on Monday when I was talking to Mike on CGTN. Heels and heroes, okay? They always sound so good. All right. eBay, Cummins, trucking, that's great to see. Home builders obviously continue to beat. I mean, there's a lot of green shoots out there. That's for sure. And then tonight, Facebook, Amazon, Apple, Alphabet, all crushed it. Alphabet was probably the weakest. Their Google ad sales fell a bit, but it looked stable after hours. Well, we're going to see, though. It might be a buy the rumor, lighten up on the news. Let's see how they after hours, they were obviously all up big, light volume. That's generally not when institutions are active in the market. That's other type of traders. So we'll see how it plays out over the next few days after the euphoria kind of dies down. But it's great news for the economy when you just see all these companies beating. It's good. It's good for everyone. Again, banks, beating. This is good. There's something to that. Going back to, it's not historically low rates, it's the spread between what banks pay for capital, or what banks pay for their money and what banks charge for their money. And that spread is like 2003 and 2009, and banks just took off after that. Boeing was a miss, not a big surprise. I mean, airlines are hurting, but that may be some longer term opportunity. General Dynamics beat, that was a defense stock, that was nice to see. So you can go through these. I'm looking at these at investing.com, and it just gives you a good feel for what's working and what's not in the short term. And obviously pick out a few and get the earnings call transcripts if you want to know more. Other than that, I think we're going to wrap it up for this week. We've covered quite a bit on the thesis, but if you understand the core thesis, and it's kind of your DNA. Either you're a person that likes to buy things when they're out of favor and then ride the recovery and just do tremendous things, or you like to kind of jump on and jump off things that are hot. It's just a different mindset. That's not what we do here. Many paths to the top of the mountain, but this one's worked very well, and I hope you found that helpful this week. Make it a great weekend, and we'll see you back next week. Next week we'll probably go back to Friday night, probably be a bit longer. But for this week, if you understood those 4 friends in low places, you understood everything you need to know for this part of the site.